Thank you very much. Welcome to day 3 of your conference. Great to be here with you. I'm Mark Woodruff from Utah Medical Association Financial Services. I want to share a presentation with you that's hot off the press from Russell Investments out of Seattle that talks about the value of a good financial advisor. As with all presentations, we have to keep the attorneys happy, so know that investment products do fluctuate in value. I'm going to appeal to the left-sided physician brain at this point and talk about how the value of a good investment advisor can help you. With A, B, C, and T, if you add these up, they add to value. A is for active annual rebalancing. B is for behavioral coaching. C is for customized experience in family wealth planning, and T is tax-smart planning and investing. I'm going to go through some numbers here pretty quickly. So that we can show you the value of a good investor. As we go through this, active rebalancing is something that everyone knows about. Not everyone does it. In fact, when you think about it, is what you're doing is every year you're selling the things that did well and buying the things that didn't do well. Not sure how many people do that. In fact, a lot of people, if they have an active rebalancing program, will turn that off. Would like to meet those that really do actively balance their portfolios. When you look at the numbers, the risk-adjusted return is a little better, but the most important part is that the portfolio, as far as volatility, goes down, and that's the value of active rebalancing. When Russell looked at that, they said that adds just over 0.1% to a portfolio. Next is behavioral coaching. This is the fun one. Being a good investor is hard, and this shows a track of how the market goes. Investors start with optimism down here, and then go up to excitement, thrill, and euphoria. And at euphoria, it seems all hands on deck, and everyone goes in. And then the market goes through its natural cycle, starts to go down. Leads to anxiety, fear, panic, and finally despondency, which may be happening right now. The last time we saw a big cycle like this was in 1999 that led to the dot-com crash. But after this despondency comes hope, relief, optimism, and then starts again. So if we look at the history of the stock market over time, it's difficult to time the market. Here's an example going back 10 years that ended in December of 2021. We'll start with $100,000. If you stayed invested the whole time, the $100,000 after 10 years grows to $462,000. If you missed just the best 10 days, you'll have $257,000. You missed the best 20 days, $191,000. And you'll find that a lot of the big up days follow some of the big down days within a few days or weeks. If you missed the best 30 days over that 10-year period, you'd have 151. And in this 10-year period, if you missed the best 51 days, you would actually lose money. Notice, every 10-year cycle changes. And if you were to do the 10-year cycle last year, it would have been 33 days. So if you think about 10 years, that's about 2,650 days of market trading, and if you miss 51 of those over the past 10 years, you actually lost money from principal. We'll go to the next slide here. The average investor, according to Russell, will earn 7.15, and this is in the 20-year period from 2002 to 2021, compared to the S&P index of 9.52. Why the difference? The difference is because of this market cycle, people will sell high and buy low, which is just the opposite of how you build wealth. The C stands for customized experience in family wealth planning. Every investor is different, but they do go through 3 phases of portfolio management. Those are accumulation, preservation, and distribution. And in wealth management, you often hear the saying that's attributed to Warren Buffett, the great investor: concentration builds wealth, diversification preserves it. During the first accumulation phase, you build wealth mainly by being invested in the stock market for many years. In the preservation phase, you take your foot off the gas a little and add some fixed income in there, as well as position your portfolio for lower taxes when you start the distribution phase. The stock market, as we know, goes up and down and up and down and up and down, but it is resilient over time. Since 1939. The value of $1 for someone that stays invested the whole time grew to $7,000. If you build a portfolio that can take you through the ups and downs, then you can stay invested and not try to get in and out of the market and try to time it, which is very hard. Being advisor isn't what it used to. In 1980, it was the broker. It was the time of Wolf of Wall Street. It was the time of Gordon Gekko, greed is good, and someone would call you and get you invested. In the 1990s, you added a financial consultant. It was the years of the discount broker, and Fidelity and Schwab and TD Ameritrade are the survivors from there. In the 2000s, you had the wealth advisor that finally started asking what you wanted. Rather than hoping you put away enough money for retirement, you start saying, how much do you want at retirement, and let's work towards that goal. And then now we have the family wealth advisor, where we not only plan for your retirement, but in passing money on to your heirs. So being the advisor isn't what it used to. The cost has gone up too, from an average in the 2000s of about 1% to about 1.5%. You know, at UMA Financial Services, we are about half of the industry average. There's a bunch of numbers on this one we'll kind of go through, but Russell tells us that the value of a good advisor adds about 1.2% just from the planning. Then T stands for tax smart. Again, we'll go through some numbers really quickly. Last year, 81% of funds paid out capital distributions. The market was up big, but the average, or 81% of funds paid out on average 12% as capital gains. That's the most in the past 20 years. You just did your taxes recently and paid, and you saw that those capital gains add up. If you have an advisor that's working with your CPA, you can do different things that will help lower your taxes, and that adds up to about 1.22. So as you look at these, active rebalancing, behavioral coaching, customized experience for family and wealth planning, and tax smart planning, Russell tells us that's a value of about 4.91%. Vanguard did a study a couple of years ago that said the value of a good investor adds about 3%. They didn't really include tax planning on there. So in a nutshell, the advisor is incredibly valuable. Let me tell you a little bit about UMA Financial Services. We started in 1993. We're in our 29th year. It started in 93 partly as an answer to many physicians who had been victims of questionable and frankly predatory private investment, private equity, and real estate opportunities during the 1980s. I know no more than a few physicians, and I'm sure you do too, who had to postpone their retirement for a decade or more. Frankly, I look forward to the time where financial planning has the barriers like you have in medicine or like there are in law. Nowadays, it seems like you can take a few online classes, take a couple of courses, print a business card, and you're a financial advisor. Education has been very important to you as you've got your undergrad, your med school, then your residency, fellowships, and we take it seriously at UMA Financial Services too. Our average financial advisor has a graduate degree, not only an undergraduate degree, but a graduate degree, and then all of us are board certified as a certified financial planner. The certified financial planner is something that you do after you get your undergrad. You study for a couple of years, you take 8 different financial planning topics, and then at the end you take a comprehensive exam that's kind of like a bar exam for an attorney. The pass rate on that is somewhere around 60%. Once you get that, you actually have to practice with someone else that has that certification as a certified financial planner. You have to get your CMEs every year. We have to get continuing CEs, it's called continuing education credits, 30 every 2 years. So like you, we're staying up to date in the financial world. So we are an independent. We are not hooked to any bank or brokerage. And so we're able to look for the best products out there to help you meet your goals. So the 6 core values a good financial planner provides are organization, accountability, objectivity, proactivity, education, and partnership, which we do. Our process is we understand your goals up front. We gather information about your financial situation. When you go to your primary care physician, usually you have a good annual exam, and we ask that you get, quote unquote, financially naked in front of us, which is a hard thing to do, but we want to know the things that you do and what your goals are, and we help you meet those. We help evaluate the risks and the opportunities, create a plan for you, implement that plan, monitor it, discuss an update, and make sure you're on the right track. So thank you for your attention this morning. I guess I was the comic relief starting off here. Hope you enjoy the rest of your day and your conference. Thank you very much.